Assalamualaikum everyone. Welcome back to our analysis of leverage funding. This is to continue from where we left earlier, as I have been emphasizing on the leverage funding system supported by the tawarruk deposit for Islamic banking, and the fear that it will not be able to mitigate withdrawal risk that may take place anytime. Thus, as I've said, the investment account fund, which is based on equity, can be one of the stabilizing factor, to dilute or to mitigate withdrawal risk in Islamic banking. But let us just look through some of the note I have given here, some definitions and some explanation to further look into the danger of leverage funding in Islamic as well as in conventional banking. And we know that the facts, the banking crisis and failure have evidenced the fact that leverage funding is a toxic system that can destroy or that have destroyed banking institution. Silicon Valley Bank, Signature Bank, First Republic Bank, these are all American banks. Thus, we should take lesson from this adverse happening in the USA. So leverage funding is the funding of asset using borrowed fund, such as bank deposit and money market funds. By borrowed funds, we mean that the fund must be returned by contract, by the way of agreement to the lending party or the depositor in full at maturity plus interest. So this is the contract by which the leverage funding were undertaken to ensure that people would put their money with the bank in view of the guarantee given by the contract on the full return of the deposit on call. Yeah, so in leverage funding, depositors can pull out their money on call. That can cause a bank run, as the case for Northern Rock Bank in 2008, global financial crisis, and lately Silicon Valley Bank, Signature Bank. Latest fall is the First Republic Bank was coming from the massive withdrawal of deposit of up to 107 billion outflow, and the loss in asset value in loans and bonds under the rising interest rate that have sent stock price to plunge from $206 in last year to $3 plus in April this year. So that is how dangerous is this leverage funding that can do on banking business, where investors will just panic and just get rid of their stock holding. That will cause the value of the bank to be worthless. Once funding is sought by issuing deposit product such as tawarruk deposit. So whether we are looking at conventional bank or Islamic bank, once the deposit product are defined as a deposit product, such as tawarruk deposit, so the Basel Committee of Banking Supervision sees it as a loan or debt that the bank owe the depositors and must be redeemed at least in full deposit value at maturity. Right? It must be redeemed in full deposit value at maturity. So that will be the implication of acquiring leverage funding. So whether we call it tawarruk deposit or wadi'ah deposit or kardu deposit, they are still deposit that must be returned at full value at maturity or on call. So this is exposing the Islamic bank to withdrawal risk, that can severely affect their ability to honor the withdrawals. This has happened back in 1997 during the Asian financial crisis, when the Islamic deposit, they migrated into the conventional deposit in a big way because of the fact that the Islamic bank were not able to provide competitive returns like what was offered by the conventional bank. Okay, so in a sense that when the bank is running on leverage funding, it means that the murabaha or the tawarruk given away are not funded by equity fund of the bank. It is funded by deposit fund, which is the leverage fund, the fund that the bank have borrowed from the depositors. So when this is happening, it implies that there is some form of moral hazard that may take place in view of the fact that the bank is using leverage funding in order to make loan, or in order to make murabaha, in order to make tawarruk. They are not using their own capital fund to make the loan or the tawarruk. They are using our money, to make the tawarruk or to make the murabaha. Right? So there is very little skin in the game. The bank do not commit enough of their own money to make the murabaha, to make the tawarruk, but most of all the money is coming from deposit fund, and this can, produce some form of moral hazard in terms of irresponsible lending. So the bank, because of the fact that this murabaha are not funded by their own money, but funded by deposit money, so they may be less responsible. So they can get very aggressive in making the murabaha, because default, will only affect their capital holding, which is very minimum, and most of the losses will be absorbed by depositors, and this is the moral hazard that can happen, adversely impacting the bank, and therefore the regulator comes in to impose the capital requirement, right? So as I have mentioned earlier, that there's two kinds of capital requirement. Number one is the capital requirement which is based on the leverage ratio of 3%. So meaning that based on the Basel III leverage ratio of 3%, the bank must hold a minimum of 3 cents for every dollar of risk-free asset, such as government security it purchases using deposit fund. So this is a case where the bank will be investing or will be using the deposit fund to purchase risk-free asset, such as government bond. So in a sense that if the bank pays the depositor 1%, and the bank will use the deposit fund to buy government bond at 2%, therefore the spread will be 1%. So that will be the minimum profit that the bank can acquire, by simply borrowing from the depositor and buying risk-free asset. And this is the least that the bank can do in order to make money. But of course, the business of banking is to make risky loan, because they can charge higher rates when the loans are more risky, or they can charge higher spread. And thus, we have the capital adequacy ratio of 10.5%. Right? So to make risky loan, banks are required to observe minimum capital adequacy ratio of 10.5%. So meaning that for every $1 of murabaha or tawarruk, the bank must hold at least 10.5 cents of their own money. So this is meaning that the skin of the game has been risen from 3% to 10.5%. But the problem here is this capital adequacy requirement, it poses high constraint for Islamic bank to use the al-bay' contract under the pretext of true sale, true leasing, mudarabah, musyarakah, salam istisna, as these contracts are inherently risky and thus not viable to be funded using leverage or deposit fund, as it triggers and exorbitantly high capital charges. So apart from the fact that leverage funding will invite withdrawal risk, then it will further cause a second jeopardy to Islamic Bank, because by using leverage funding, the Islamic Bank is not able to take opportunity to use al-bay' contract, because these are risky contract, and therefore it will pose great danger to the bank if they were to use real sale, real leasing, or equity on the asset side, because this will cause the bank to hold high amount of capital to support potential losses arising from this al-bay' exposure. So that is one of the other downside of leverage lending, apart from it is triggering high withdrawal risk. At the same time, it is restraining or limiting the Islamic Bank into using al-bay' contract, which is a very important system to enhance real sector development. So we can discuss this a bit more later as we move along in the next video. So I can hope to see you again. Thank you. Don't forget to comment and to subscribe. Assalamualaikum warahmatullahi wabarakatuh.